What if I told you that's an easy $2,500 tax deduction majority of the people in the U.S. can actually qualify for? Currently, 25% of our population are currently paying back student loan debt. So that means out of our total population of 329 people, potentially 82 million people can qualify for this student loan interest deduction. At the beginning of every year, you should receive a Form 1098E, your student loan interest statement, telling you how much interest you actually paid to your lender. Now, if you made interest payments of $600 or more on one or multiple qualified student loans, your Form 1098E needs to be sent to you by January the 31st. The student loan interest deduction may be deductible if you meet certain key criteria. First criteria is the loan has to be taken out for you, your spouse, or any person who was a dependent at the time when you borrowed the money. And this deduction is going to be available for both your federal loans and any private student loans you receive. Second, to be a qualified student loan, the loan has to be taken out to cover the cost of educational expenses for college. You can only deduct interest if the student loan actually covered school-related expenses. So if you use the funds for personal expenses not directly related to your education, like buying a house, car, going on a shopping spree, you're not supposed to deduct those amounts. You're supposed to reduce your actual deduction by that amount. Third, you must be legally obligated to pay the interest on the student loan. So if you just pay the child's or your relative's student loan interest, but you aren't actually obligated to pay it, you cannot deduct that interest on your tax return. If you can check off those boxes, congratulations, you actually have a qualified student loan that's actually deductible. Now, the loan is qualified to be deducted, but with all deductions and credits, you still must meet specific criteria as a taxpayer in order to claim this deduction. The first qualification for you as an individual is your actual filing status. You must file as single, head of household, qualifying widower, or married filing jointly to actually claim the student loan interest deduction. If you are following any other statuses, you can possibly deduct your student loan interest, but you cannot be claimed as a dependent on anyone's tax return at the same time. You can deduct interest on the student loans whether the amounts were paid by you or by your spouse if you are married filing jointly. Now, if you are married filing separate on your return, you cannot claim the student loan interest deduction. The second qualification is your income. The amount of student loan interest you're able to deduct is going to be gradually reduced the higher your income becomes. So for a single file in 2018, the deduction started to phase out for the income levels at $65,000 up until $80,000. You cannot claim the student loan interest deduction if your income was higher than $80,000 a year. Now, there are new phase out amounts for 2019, which are now $70,000 and $85,000. The phase out amounts are also similar for the head of household and qualified widow returns as they are to the single. Now, if you were married filing joint, a return in 2018, your deduction would have phased out if your income levels were from $135,000 to $165,000. You would not be able to claim this deduction if you were married filing joint and your income was greater than $165,000. Now the new amounts for 2019 for married filing jointly is now $140,000 through $170,000. The maximum deduction you can get, regardless of how much interest you pay throughout a year, is still going to be limited to $2,500. So if you're paying your student loans, don't forget to take this easy deduction just to minimize your tax burden throughout the year.